We're highly occupied now, very tight, very low exposure, and rents continue to grow nicely in the Bay Area. So those are pretty much the most favorable for those reasons. On the flip side of Southern California is still kind of the low end. Specifically Los Angeles. Los Angeles is growing. It's in recovery mode. It continues to improve, but at a much slower pace and at a much more uneven pace. We're finding in LA continues to be a little lumpy. We'll get a good run and then we can't hold it. We'll get a good run and they just can't hold it. And I think that's based on just the employment situation there is not gaining consistent legs. A lot of dependence on local, state, and city government, and those are still shedding some jobs. Entertainment is up and down, but it's trending down. The port business has been up and down, with import-export. So it's a big economy. Now there are certain submarkets like downtown, Mid-Wilshire, Koreatown, Little Tokyo, maybe big cities are doing much better. Further out, it's less consistent. Valencia, Santa Clarita, parts of Santa Clarita. Orange County, on the other hand, has really gotten good momentum of late. Very strong leasing season. We're highly occupied there. Left to lease or exposure is down in the 5% range, and rent growth is accelerating quickly in Orange County. And then San Diego, everybody knows the story. It's the military town. It's been whipsawed by military rotations. May 21st, we saw over the horizon of the Pacific the Carl Vinson aircraft carrier coming over, and it docked. And the next day we leased 200 apartments. So it's coming back very quickly. It's a small market, but it's influenced by the military. So those are the ones we're kind of more concerned about. Phoenix had a great run. It's not quite so strong anymore, and we are starting to see leading indicators of some single-family home buying and maybe some renting in Phoenix. But that's one of the poster children for the single-family debacle. So to be expected.
Great. Let's kind of draft out that single-family commentary and talk about just threats to your business. The REITs generally have not seen a big pickup yet in move-outs to buy homes. What's kind of the EQR house view on where the single-family market is? Are we at bottom? Are we bottoming? Do you have kind of an in-house view on the homeownership rate?
Well, I guess we've not made a call, Andy, as to what we think where the single-family home ownership rate will kind of bottom out, but we certainly do think that it will continue to decline. And that's just on the national basis. When we look at our individual markets, we are not seeing any significant increase in move-outs to buy single-family homes from our residents. In markets where single-family housing is the least expensive, we have seen a little tick up in people that are moving out of our apartments to buy single-family homes, but it still is nowhere near what the historical run rate has been. And as we think about this demographic, this echo boom demographic of 80 million people, and they're marrying later, they're having children later, we just think that they're going to be apartment renters longer, and they're going to want to remain in high density sort of urban environments longer than what that age group might have been in the past. And just some interesting statistics about our portfolio. But 43% of our units across the country are occupied by one person. And then another third of our units are occupied by two or more people that do not have the same last name. So while we're the first to admit that there certainly would be pent-up demand for single-family home ownership across our portfolio, we don't see for that to be a significant threat to our operations. And we do believe that when that demand begins to be met, it will be in an economic climate and a confidence climate in which an awful lot of the 6 million 25 and 35-year-olds that are still living at home with mom and dad will be coming into the rental market, and will be sufficient to backfill anyone that may be moving out to buy single-family homes. So we don't see that as a big threat on the horizon.
Another threat's obviously supply. Given the rebound we've seen in rents, apartments are one of the few major property sectors where you have seen a significant ramp up in supply. And we're not back to historical building levels yet, but it's coming. So how do you view supply today?
Well, we've done a lot of analysis on supply, and you're right. While as a percentage of historical deliveries, it looks like there's a whole lot that's coming, when looked at an historical basis and looking at historical run rates, it's still well below what those run rates have been. But when we look at our markets and we look at what household formation expectations are in those markets and compare and apply to that what we think is a conservative apartment capture rate, and compare that, what we would suggest would be the incremental apartment demand to those new supplies, generally we're not terribly concerned. We think that those markets will remain generally in balance. And that doesn't mean that when apartments are delivered in a marketplace, it won't have some impact. If you're the property across the street, you'll feel it. But we think that some of that impact will be very short-lived, and that the overall health of the markets on a longer-term basis will be fine. There certainly are a lot of apartments in planning stages. A lot of people talking about building. We think that certainly not all of that will get done. But as we look today at deliveries, that being product under construction, will be delivered in 2012, 2013, 2014, and look at what we think the incremental demand will be, those markets we think will remain in balance. And particularly when you're in a marketplace that spreads, we're 96%, 95% occupied. If you're in balance of new supply and incremental demand, you'll still be in a position where we will be able to raise rents. If we were at a 90% occupancy or something lower, it would be a challenge to raise rents given that. But the very strong levels of occupancy we have, the incremental demand that we expect, we believe that these markets will be able to absorb this new supply, and it will not be a long-term negative impact on these markets at all.
Different topic real quick. I guess a potential threat is, and it's really a hot topic in the market today, single-family rentals. Can you comment on maybe that business? I doubt you'd ever get into it personally, or have you are getting into that business, but do you think this kind of new breed of institutionally owned and operated single-family rentals poses any threat to your portfolio?
I'm not sure that it poses any more threat to that ownership versus any other sort of ownership. I mean, those units exist in a marketplace, and if they're available to rent by some institutional owner who's aggregated an awful lot of assets, or they're owned by the mom and pop, it's still units in that marketplace. We think that much of that product will be occupied by people who were formerly homeowners who might have been dispossessed of their home, but they have chosen that lifestyle, they've chosen that neighborhood, they've chosen that school district, and they're likely to be occupying that. Again, when we say we've got 43% of our apartments occupied by one person, we're not seeing them rush out to rent those single-family homes. Certainly, will that be impactful in Phoenix and Atlanta and Orlando and the Inland Empire? Sure. I think if that product is made available to the rental pool, it will have some impact. But I think when we look at our portfolio, Boston, New York, Washington, Southern California, San Francisco, Seattle, we don't see those markets being hugely impacted by that. And we're seeing statistics of people moving out to rent single-family homes. We just don't think that's a meaningful number for us today.
Great. Before I switch gears, talk about asset values. Any questions from the audience relating to either Archstone or fundamentals before I move on?
Or just fundamentals?
Oh, sorry.
With respect to single-family rental, do you see any viability for the business model or on institutional level, or exclusively something that is going to fail?
Very much a question.
The viability of the single-family rental model. What do you think?
From an institutional perspective, there are a lot of very smart people looking at this, and I'm not suggesting that it can't be done, but I'll tell you from the direction that we look at the business, from an operating standpoint, David and his team operate what we own extremely efficiently and extremely effectively. That's by having a lot of units in a very dense sort of position. There's an awful lot of asphalt, an awful lot of landscaping, an awful lot of siding, and an awful lot of roofing on an individual single-family home. And I think that to own a large portfolio of assets across a big geographical footprint, I would not be surprised if financial sponsors looking at that business won't woefully underestimate tenant retention costs, tenant approaches, what it costs to put a tenant in. They won't underestimate what vacancy will be. I'd be surprised if they didn't underestimate what repairs and maintenance would be in the whole sort of process. I think that, can you make money on this of buying these single-family homes at one price and selling them at another price maybe down the road as these markets recover? I suppose. Whether or not that will deliver the required returns, I don't know. But I think that it's going to be extremely difficult to really efficiently and effectively own and operate and manage those things and they just, won't compare to the kind of efficiencies and that we're able to deliver in what we operate. So we looked at that from our perspective and see that as being a challenge. Can I tell you it won't work? I can't tell you that, but I think that the people got to have a lot of work cut out for them to actually make it.
You seem pretty upbeat on different company or different industries hiring, and I wonder how you reconcile that with the non-farm payroll going from 200 to 60.
Well, all we can report is what we see, on the ground. And I think the college-educated young professionals, that cohort, is highly employed. I think actually their unemployment in that segment of our economy actually went down and improved again to a very low number. Yeah, you read the headlines, but you don't know where those people are. And we're 9% unemployment. You've got 91% employment. You have to see the glass half full. So what we see from the markets that we're in, the sub-markets we're in, the buildings that we have, the price point that we operate at, is a very healthy demographic. And a lot of young people, highly educated, highly motivated, very entrepreneurial. They're engaged in the economy, and they're making some good wages.
The unemployment rate of college educated is something in the fours. Yeah. So notwithstanding an 8% national unemployment rate, and we talked to a lot of manufacturers, a lot of people in need of skilled laborers, and there's a shortage of skilled labor. So the markets we're focused in, there's been good jobs. There has been income growth, and again, as Fred said, we're having no problems keeping our apartments full at ever rising rates.